Hello everybody, this is Max. This is Dextrader.com, and in this series is about the MACD and what is it good for and how do we use it. Well, first off, the MACD stands for Moving Average Convergence Divergence. And this is a very important indicator for everybody to be able to get familiar with. We'll also be doing later on versions of this with the stochastic and a couple other small ones, support and resistance and those things. And these are more of an advanced way to look at this process. But for all of you to know what the MACD does and how all the different components, it's very important for all of you to know before we get started talking about this is to not try to overanalyze the information. Okay, I want you to take a step back, kind of just listen for a few moments and not try to microanalyze every line and every detail. Okay, this is very important for all of you traders that are here, not to be paralyzed by analysis. Okay, so the MACD is an extremely popular indicator that is used for technical analysis, and what this identifies is an overall trend. Okay, it employs two moving averages, which means how much is the price moved over an average amount of time, and this creates us to be what we refer to as a lagging indicator. Okay, it can identify trend and direction and what we refer to as momentum. Okay, this is the difference between those two lines. And that's what creates the histogram, which I'll show you online on that system. Before I do, I want you to know of three major components that are made up of the MACD. The MACD line itself is the result of taking a longer-term EMA, an estimated moving average, and of subtracting it from a shorter-term EMA. Right? This is most commonly used with values of 26 days or longer, and 12 days or shorter. Okay, that's where you get the 26, 12, 9. Sometimes you see that. You see that number a lot in the MACD because it's a very popular method. But this is really about your trader's choice. Messing with these numbers are going to mess around with your overall value of the direction and the trend and the momentum. So keep it at this level here at 12 or 26, 12. On the Dex Macd, you're really stuck with it. I mean, you could change it in the indicator on the series, but the stuff that's on the WB for Dex data charts, you can't really mess with. You can't change those values because that value itself is a very strong indicator and momentum indicator. Now, the reference of the signal line, which I'll show you here in a minute, is the EMA of the MACD itself, right? And this is described as component 1 in the system. Right? The trader can choose what period of length to make this one, like we were talking about, but the 9 level is where it's really, so you get the 26, 12, and the 9. The 9 is reference to the signal time. Okay, so this is pretty powerful for you. So 26 for the days to 12 on the days, and the 9 is the signal indicator itself. The histogram, which is that little line chart that you see that has below 0, above 0, looks like a little a bar chart, if you will, is the difference between the two lines themselves, right? So when those two lines differ, how much they differ by is what we refer to as momentum. So if the signal line is different than the MACD line, then how much they are will be represented in how big the histogram is. And I'll show you that here right now. Before we go over to show you that, the secret fourth on the Dex Macd is another moving average that I applied, which gives you a third variance of direction. Okay, if you use this in like a moving average of all 4 lines facing or all 3 lines facing in the same direction, this will help you out too and to help create a level of momentum and direction, which I'll show you here in a technique very shortly. Okay, let me get here. Now, some of the components of the MACD, as we were talking about before, is that you see the 26, 12, 9. In this particular screenshot here, is that usually the smooth line that we will refer to, this is the signal line, okay? Then you have the MACD line and the signal line, all right? So the blue line here represented on the chart is the line you're really paying attention to. This is the one of the action, right? This is the most current line. And this is the one you really want to look at in the direction when it's crossing over and what it's doing, right? because here it's crossing up. But if you looked at the other line, it looks like it's crossing down, right? But in our case, you really want to pay attention to the bluer line, okay, in this model, and I'll show you the different, little bit of different colors here. Now I tried to keep them all the same in the process, but okay. The histogram itself is the difference between the two lines themselves here. Let me see if I can change my color here just a little bit. Guess not. All right. Let me see. Put it right there. There you go. Okay. Is the difference between there and there. All right. So the bigger the difference, the bigger the bar here. And okay, that's right. So there are other components of the MACD, which I'll talk about here in just a second. But the biggest ones are, and I'm sorry, I'm getting distracted. There's things going on the side here. But there's things that happen with this indicator that you have to pay attention to that create what we refer to as like a signal or a process, or what I refer to as an event. Now, the event happening are in three different fashions. A signal line crossover, okay, it's this one right here. This one right here. And then a zero line crossover. And then, of course, divergence or convergence in the process. But we refer to it as a bear divergence or a bull divergence, all right? There's a fourth one in this value of creating to where all three lines are pointing up. And I call this a directional convergence, when everything is facing in the same direction as the system is going. You're looking for trend value. You're looking for complacency within the trading. You can use this in spreads and binaries if your line is here, if you got in at this price here, and everything is pointing up, you look like it's still a pretty good deal to be into. But everything starts to curl over and looks like it's about to do a crossover. Then it might be time to say, hey, look, there's storm clouds brewing. Let's get out, right? So there's those kind of things to look for. In a crossover event, just like this one here that you see, okay, when it comes from the bottom and up, it's called a bullish signal crossover. These signal crossovers are the strongest when they appear above or below the zero line on your MACD, right? That's this center line that you can kind of see right here. So this is the positive side, and this is the negative side, right? So this is plus, and this is minus zero, okay? As you can kind of see over here. So when the crossovers happen below and coming upwards, this is called a bullish signal crossover. Usually means in reference that the market's going to continue to trend up, okay? A bearish signal crossover happens in the plus side, of course, and coming down, right? Now, there's also you would call this a bullish crossover in the up position, but this would be contradictive to an actual movement. It's an event series that happens, this crossover here, but as you see, it eventually eliminates and comes down, mostly because it's happening above the zero line. Okay, that's from what I have seen in this market, in this industry. When these crossovers happen in the direction, or in the opposite direction of, say, overbought, oversold kind of mentality, like it's really high up on the chart here, and it crosses over in the opposite direction, there are events that are happening. Now, whether or not those events are strong enough to move the momentum in the direction that it needs to be, that's where we really got to look at, okay? So usually within a crossover, you're waiting at least 1 or 2 bars for confirmation, because these crossovers, just like a stochastic, don't happen unless the bar that it's on closes and there's a little wedge there, right? We've all seen this before. We've all seen it do a semi-crossover, like 1 second it's like touching, and then the next it's going off again, right? Because when the bar closed, it didn't close off in the direction. So we wait until at least 1 bar next, the very next bar, to get that little pie wedge that you get, right? When, for that bar to be closed. Now, once that happens, you're looking for momentum. Now you're looking for that direction to happen. And this is usually pretty good when you're using like the SR maxes and the base signals, right? You see the first crossover and you're out. If it's in the opposite direction where you're going, you're done, right? Just go cancel it out, because it's going to move towards that direction for you to be able to lose that trade if it happens within a certain period of time. Now, a crossover or an event can be utilized for your advantage with getting into certain trades, getting out to certain trades, okay? Using it on your 5-minute series, it's usually pretty strong. But in a 5-minute series, the lower the time that you use, okay, 1 minute, 5 minutes, 20 minutes, 15 minutes, so forth, okay, remembering that the MACD is a lagging indicator, you're going to have a little bit mixed results trying to use it completely as a crossover event for that process, right? You can use this as a crossover event on a 5-minute, but use it as an overall value of the trend. Which way is it going, right? And then bring it to validation on what we call price action. Because if this is going upwards, you want to make sure that your trend is going upwards as well. Like if you're about here to make the trade, you have a long trend happening and it starts to weaken out, right? The divergence starts to happen, or the difference between the two starts to lessen, like right in here. This may not be a good time to be getting in until another major event is proven, right? You don't get in as soon as the event is proved a crossover. You wait a little bit for momentum to build back up again to stay in that series, right? So this is a good practice when you're trading on 5-minute signals, that try to stay away from these major events, right? As they're collapsing in, if it starts to fold in a little bit, it might be a good signal to stay out until it confirms again and grabs momentum, right? Because we like this movement because the trend is our friend, right? And as things start to fall apart again, it might be something to kind of stay away from at that point when you're at the lower levels. At the macro levels, the 1-hour trades, half-hour, 45-minute, 2-hour trades, this is really good, a really good indication of direction of that trend happening. You can usually be able to get into good trades at that point, or stay out of ones that are in the opposite direction that you're doing, right? That makes sense, Mike?
Yes.
Okay. Now, in using that crossover event process, there's another process called the divergence. And divergence really means the conflicting information on both parts, right? So when the price is trending down, as we see here in this event, okay? And these are just moments in time that we start to look at. Usually at either we're about to trade, we look at what is the market doing at that point. Like if this was a signal that came out at this particular time, we might go back to find if it's trending up. If it's mostly trending up at that point, we look for divergence in that process and what that direction is, right? So if we're about to get into a trade and it's for a buy, we would go back to see if the MACD and price are divergence and what direction they are. When the price is heading downwards from that position, right? You look over a period of time, you use the same amount of equal time to see what the MACD is doing, right? And that's pretty important to know, that if it's going inwards like this, right, it's bigger here and shorter here, that's called a bull divergence, or divergence bull MACD. That means that the price should, within a high rate of success, continue on its trend of its value of being a bull trend. When the value is heading away from each other, shorter in the back and longer in the front, I guess you can call that a mullet. Sorry, that's bad. Or a reverse mullet, maybe. When this happens, this is called a bear divergence, and this means that the market should continue heading in a downward direction from that point. But again, this doesn't mean that you go look for, oh, it's diverging right now, let me get in because this has to be going down. You're not doing that. You're waiting for another process to happen, a third process, and that is either another event not happening within the MACD, but happening maybe externally, either through a stochastic or through our signals or what have you. Let's say you're trading the SR maxes, and the SR max signal comes out right at this particular time. And on this particular time, you go back and look for two major points, usually a point in what we call structure, right? You're looking left a little bit. You're looking for that, where is you find the trend, which way is the trend going, which way is it happening, If you can't find the trend, simply go back to a point in reference of height, right, of price, and come down to the same exact point on the MACD to the point of the signal, and you measure it out. If they're pointing away from each other, okay, that means that it possibly, with a high level of success, to be going down still on the bear. If not, if they're going towards each other, it means that it could be going up in that same direction. So if that's the case on your signal, if your signal is heading upwards, right, or doing what they call out a bull signal, right, or a buy signal, then if you're in a bear divergence, that would be a signal you would do what to? You can answer, Mike, or anybody in there.
It would be going up.
If it was in a bear divergence like this, it means it would be going down.
Oh, going down.
If your signal was for a buy, it's all right. I know not everybody's paying attention. It's okay. If somebody even asks, is this pre-recorded? Yes, I know. You're gonna have to watch it a lot. If your signal is going up and you're in a bear divergence, this means something that you may not want to be into, right?
Right.
Now, would you do the opposite then? And the answer is no. You wouldn't just do the opposite of what the signal is. That means that there's a lot of conflict happening in that market. When all these things go against each other, there's something off, right? So when the bear divergence is happening and a signal is happening in an opposite direction, that means you got conflict, and that conflict is not good to hedge on, right? It might be something good to stay in the middle of, like with an iron condor or something to that effect, but that's advanced trading. I just want to show you how to use some of the main tools that we have and how to begin to use the MACD as a massive structure on validation of your signal. Whether it be, now you won't be able to really do this in a 5-minute capacity, right? The signal comes out, you got to look at the divergence, you got to get back, there's no way, right? You're not going to do so consistently. If you do, you're a superstar, right? But if you don't worry. You're just a regular trader at that point. You don't have to be a superstar to be a good trader, right? In fact, you'll burn out faster if you're a superstar all the time. So, but this is a tool to be able to use on a macro level to really take your time and look at it. I use this method when I trade the dailies. When I trade the dailies and I'm looking to find out, here's my daily signal, I go back and I look to see if the MACD is diverging, or, diverging or bear or bull, and I kind of say, all right, is this something that it's going to come back and pick up the price, and how much is it going to come back to? And I kind of look at price action, and I do a few things. I use the tools that are in front of me, the things that I've learned without having to really overanalyze everything, right? Because this analyzation only comes in 3 major parts. And that's, you look at the time of the signal, you find some structure previous, you measure the signal on both the MACD and the direction, and you validate, is it divergence bear or divergence bull? It's that simple. You don't need too much technical analysis. Jim, I'll answer that here in a moment. Now, how to use all this information is very important to all of you. Of course, first off, you got to get in and use it, right? You got to get in and start to see all the different lines and what they do and how they confirm to your signal. And learning how to read price action and the support and resistance of either because the trading view doesn't have support and resistance, but the MACD or the Dex Macd and the Dex indicators do, and the Dex data chart system does as well. So learning how to read those and validate, and making price action is so easy, it's not even funny, right? Finding where that price action and other levels are is so easy to use. That's another video. But here, using the Dex Macd and using the MACD at all, you begin to be able to read the value of it converging or diverging in a bear or a bull fashion, what the moving averages are, making sure that all the lines are pointing in the right direction. You see the events that happen on the crossover. There's another event that happens, I forgot to mention here on a crossover, what we refer to as the zero crossover. And I didn't really go into this too much detail. I do believe in it, but I didn't want to give you too much, right? So when the blue line crosses over, the 0 point is usually a pretty good indication and value of direction as well, right? But this is another value in that. So if you get this, or once it crosses over by one line in that there is a lot of momentum. If there is a lot of momentum, the distance between the two, there's a possibility of that it's going to continue on in that direction. You can use this, as you can see here, as another indicator within the process here. But again, you don't get a lot of notice to this, right? If you wait one for confirmation and it doesn't just bounce off, then it's usually pushed into that in that direction already. And there's a lot of stuff that happens at that point. All right. But the biggest tool you're going to be able to learn how to use by reading price action, using the MACD in this fashion, and the biggest asset that you have, of course, is your own common sense. And that means don't rely on a single tool. Your biggest arsenal and your biggest strength is the bucket of tools that you have, the toolbox itself, and using a little bit of everything. A craftsman never uses only one tool to do every job. And that's what you have to remember, that the Dex Macd, support and resistance, the charts, all of that is just one tool. Even the signals. The signals are really just a fancy group of indicators that have been put together to read the value of a trend or movement of a trade and give you a range for you to be able to utilize, but it's still just a tool.